Well, we are really delighted here on Tax Notes Live to be joined by Chairman Dave Camp, currently the Senior Policy Advisor with PwC. And first, sir, I want to congratulate you on your leadership of the Ways and Means Committee, and in particular on your tax reform bill. I and many others continue to regard it as an exceptionally well-crafted and balanced plan. It reduced marginal rates while broadening the base, which is the tried and true approach to fundamental tax reform. I'm curious, though, how that entire episode has influenced your current thinking about tax reform. In what ways will the next piece of tax reform legislation resemble or not resemble your bill?
Well, I think there's general consensus that our tax code is broken and that we need to do something to fix it. And one of the things that the proposal I and members of the committee worked on showed was that it could be done, that this isn't an issue that's just too complicated to address, that you can come up with a pro-growth, job-creating tax reform plan that will make the code simpler and fairer and really make this, sort of uncertainty about dealing with the IRS more certain. And that's, I think, something that will influence tax reform going forward. There are a lot of different ideas being discussed right now. I do think we'll probably still go to a lower rate, broaden the base type of structure, but that remains to be seen because we do have a new Congress and they're looking at these issues in a new way. And there are some very robust proposals on flat tax as well as the fair tax proposal. But I think at the end of the day, it's going to be about lowering rates and broadening the base. Also, one of the things we were able to do is for the first time use dynamic scoring, which actually gave a real-world example of how tax policy would affect the economy, people, jobs, and their lives. And I think the next tax reform bill will also use dynamic scoring in an even better way, because we didn't really get the dynamic score until after we'd written the bill. But now they can go into writing a new bill knowing that dynamic scoring is a possibility and that you can actually grow the economy significantly, which helps families and workers alike.
Well, that only makes sense because, as you say, it gives you a more realistic view of the world and takes into consideration behavioral responses. And speaking of behavioral responses, a lot of people focus on the headline rate, say with the corporate tax. Now, your bill would reduce the corporate rate from 35%, which is the highest in the industrialized world, down to about 25%, which is much closer to the OECD average. Now, I've often wondered if in the tax writing process, if you started by trying to identify a rate that was deemed competitive by international standards and one that would be acceptable to various stakeholders, and then sort of work backwards to figure out how to finance that rate reduction. So to rephrase the question, how significant was that headline rate as a central design element?
Well, it was very significant. I mean, there were really two ways we arrived at that number. One was it was a number that we got from a lot of the business community in the hearings that said pretty uniformly, if you could get our rate to 25%, a lot of the incentives to engage in some of the, you might call it, creative tax planning wouldn't be as prevalent because 25% rate would make sort of those incentives go away. The other thing is we were very aware in the committee that was also the OECD average at that time. Since then, of course, 5 years ago when I started on this project, the OECD average has come down, and you've got a number of significant economies lowering. So I don't know that 25 is the magic number it was 5 years ago, but it was certainly a starting point, and we did use that, obviously, in our House budgets as well as really sort of the marker to try to get to. But it was really a combination, both hearing from the business community that would take away some of the perverse incentives in the tax code and level the playing field to a great degree. And also it was where the OECD average was, where many of our large economies in the world and many of our competitors are.
Well, every tax reform plan has to have revenue raisers if it's going to reduce the rate. And one of your revenue raisers was to scale back accelerated depreciation. And that feature was an important pay for, but at the same time, in retrospect, it may have turned some folks away because they value those provisions. Going forward, do you think it's possible to significantly cut the corporate rate without touching something that is a big price tag on it, like accelerated depreciation?
I don't think there's any one particular path you have to take in order to reduce the corporate rate. I do think, particularly we're seeing in the presidential campaign, some presidential candidates, particularly on the Republican side, look at unlimited expensing. That also brings with it some trade-offs as well. But because of scoring dynamically, the revenue requirements may not be as the same or as significant as they were when I and the Ways and Means Committee were putting together H.R. 1.
Now, I want to ask you about the international area because this is appealing to so many people in the globalized economy. You have to look at a country's international area. And you would have moved us to a territorial regime, which is widely used around the world, including most of our major trading partners. But it's quite different from what the Obama administration seems to prefer, which is a sort of minimum tax on foreign profits. Now, admittedly, President Obama's minimum tax is somewhat discounted relative to his proposed rate for domestic profits, but it's still a far cry from a dividend exemption system. Why do you think territoriality is preferable to a minimum tax on foreign profits?
Well, part of why we need to reform our tax code is because we're out of step. And we're not just out of step on the rate or the statutory rate or the effective rate, but we're also out of step on our system of how we tax internationally. And when you think about the 86 Reform Act, that was really on business and individuals and domestic taxes. It really didn't reform the portions of our international tax code. So those haven't really been addressed since the 60s. And the world has changed dramatically. We're obviously competing in ways. You can now, with a click of a button, move finance around the world. There's a lot of alternatives for investment that weren't there in the 60s. So we really must modernize our international tax system. And I think it's going to be very important to do that. And I think the next proposal on both either international tax reform or on comprehensive tax reform will have a proposal. And there is some bipartisanship sort of emerging on a dividend exemption system, and I think that's something we need to continue to focus on in order to really not have us be an outlier when it comes to tax policy. And what does that mean? It means that U.S. companies pay a double tax in order to bring the profits they earn abroad back to invest here in the United States to create jobs and increase wages, whereas other countries that we compete with, they can bring the dollars they earn abroad back without paying a double tax. They only pay the tax in the country where the dollars are earned. So that puts us at a tremendous disadvantage, our U.S. employers, as they try to outcompete other businesses around the world so that the growth and prosperity and jobs they generate stay here in the U.S.
It's a huge disincentive with all those locked out profits that aren't really being put to use, at least not domestically. That definitely screams for attention, the territoriality aspect of tax reform. Among the other virtues of your plan was that it aimed to be both revenue neutral and distributionally neutral. Yet we occasionally hear rumblings around Washington that one or both of those objectives might need to be sacrificed in order to make a package more palatable. Do you think it's necessary that tax reform adhere to these concepts of neutrality?
Well, I do think you have some different prerogatives now than you did 5 years ago, putting something together. And part of that is, as I mentioned earlier, the idea of a dynamic score. If your plan actually in reality grew revenue to the federal government, it may not necessarily have to be revenue neutral in a static way because of the reforms create an ability to grow in a real sense. And I think that's going to be the more important number to look at going forward. But I took the first stab at this in a very long time, and on the committee we decided that it was important to do that so that our plan wasn't dismissed just from the get-go.
Mm-hmm.
But now that we can see that you can put together a plan that is revenue generating and job creating and increasing incomes, I think that you're going to see an emphasis on how do we get the kind of growth we need to put more people back to work. And we still have a record number of people that are not in the workforce.
We do.
We've had about a decade of 2% GDP growth, and while we may look better than some other parts of the world, I think there still is a lot of unhappiness with the direction the country's taking, and I think some of it has to do with the fact that median incomes have not advanced the way they should, and people really have a sense that the ability to be upwardly mobile is actually in question. And so I think it's going to be more important to get the kind of plan that actually gets our economy growing and moving and really gives people a sense that, the future will be brighter. And that, I think, is going to be more important than those restrictions.
Yes, and I've yet to meet an economist who thinks pro-growth tax reform is a bad idea. So those are excellent thoughts. Now, there are some policymakers who advocate replacing their current corporate tax with some kind of a variation on a business cash flow tax, or what some folks might loosely describe as a subtraction method VAT, which is absolutely not to be confused with a European-style transactional VAT that you see in some other countries. What are your views on this concept of shifting to more of a consumption-based tax code? Does that idea have much merit?
Well, it is certainly something that is being discussed right now, and it I think has some favor among some economists and think tanks. I do think, though, that we're somewhat unique in the U.S. in that we also have state-level income taxes, and it really is almost a federalism issue that we really have left a sales tax or consumption-based tax to the states pretty much. Not entirely. It is a different approach. I think it really needs to be sort of spelled out in greater detail. I think that is maybe an area where if you saw the I's dotted and the T's crossed on what a business cash flow approach might do, it might make the case. But I have concerns that is an approach that has really been vetted thoroughly enough at this time.
Walter, any predictions about when tax reform might actually happen and what stars would need to be aligned in order for that to happen?
Yeah, I think we may need the stars, the sun, and the moon to align in order to get this done. But clearly there's, I think, a lot of consensus that we need to reform our tax code, that it's broken and can't be fixed, and we need to make some serious reforms. I do think, though, that there's a lot of good work going on in the Congress right now, both in the House and the Senate on this issue. There are certainly there's a lot of debate in the presidential campaign about this from both people of both parties. I think that we probably need to see where our new leadership goes in the coming year, whether our new president has this as one of their top 2 or 3 issues. And I think with presidential leadership, I think there's a chance. Almost every president since Reagan has had a significant tax reform bill in their first year in office, and I think the next president, no matter who that is, will be no different, and there will be pressing concerns that will require a significant approach to tax policy in the first year. So I'm hopeful that would be more than just nibbling around the edges, that it'll be actually a comprehensive reform plan that will really create the kind of growth opportunities that Americans are really searching for.
Chairman Dave Camp, Senior Policy Advisor with PwC, thank you for joining us on Tax Notes Live.